My name is RJ. I'm a Canadian tax advisor with over 5 years of experience. Today, what I'm sharing here isn't theory, it's based on what CRA is actively doing on real files today. If you own property, invest in real estate, or plan to sell a home, this video is extremely important for you. The CRA is paying close attention to real estate transactions, especially short-term property sales. Many people believe that once a property is sold and tax is filed, the story is over. That is not how CRA works. Audits often come years later. In this video, I'll explain how real estate flipping is taxed, what rules CRA uses, and how you can protect yourself calmly and correctly. Real estate is one of the largest sources of undeclared or misclassified income. Property transactions involve large dollar amounts, and even small classification errors can result in significant tax differences. During the 2021 and 2022 market boom, many properties were bought and sold quickly for profit. CRA knows this and is now reviewing those years carefully. Even if the market has slowed today, audits from those years are still ongoing. A very common misunderstanding is that if CRA hasn't contacted you yet, you're in the clear. CRA audits are not real-time. They often happen 2, 3, or even 4 years after the transaction. This means a property sold in 2021 or 2022 can still be reviewed today. The timing of an audit has nothing to do with today's market conditions. CRA now relies heavily on data matching. They cross-reference land registry records, renovation and development permits, municipal data, income tax returns, and GST or HST filings. If the numbers you reported do not align with the data CRA already has, your file may be selected for review. One of the biggest changes came into effect on January 1, 2023. If you buy and sell a residential property within 365 consecutive days, the profit is automatically treated as business income, unless a qualifying life event exception applies. This means no capital gains treatment and no principal residence exemption. This classification makes a major difference. Capital gains are only 50% taxable. Business income, on the other hand, is 100% taxable. In higher tax brackets, this can mean paying tax on more than half of your profit. In some provinces, that rate can exceed 50%, which is why this rule can dramatically increase your tax bill. Simply reporting a sale incorrectly can result in a very large reassessment. Here's a real example. A client bought a house and sold it within 9 months. They reported the profit as a capital gain. CRA reviewed the land registry timeline and reclassified the profit as business income. The tax payable increases significantly, and interest is added on top. This is very common. There are exceptions, such as death, divorce, serious illness, job relocation, or insolvency. However, CRA does not apply these automatically. This is critical to understand. The burden of proof is always on the taxpayer, not on CRA. CRA's position stands unless you can provide evidence that supports your situation. Good documentation often makes the difference between acceptance and reassessment. CRA also closely monitors repeated use of the principal residence exemption. If multiple properties are bought, renovated, briefly lived in, and sold tax-free, CRA may argue the activity is actually a business. If CRA succeeds, the profits may be fully taxable and GST or HST may also be reviewed. Many people focus only on income tax and completely miss the GST or HST risk. When CRA reclassifies a sale as business income, they often also review whether GST or HST applies, depending on the facts. In certain cases, this can result in both income tax and GST or HST being assessed in the same review. This double impact surprises many taxpayers. If you were active in real estate during 2021 or 2022, it's important to review how those sales were reported. Keep supporting documents such as utility bills, moving expenses, and proof of occupancy. Being prepared early can make a significant difference if CRA asks questions later. Real estate audits are no longer random. CRA relies on data, patterns, and documentation. If you've flipped property, understanding the rules and being prepared is more important than ever. Thank you for watching.